And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the first day of April. That's right, it's April Fool's Day. So, of course, considering the reality we're all living in, it's all April Fools now. So, not too much to be worried about today about any pranks from your friends. Outside of that, though, hope you had a wonderful Easter, had a great weekend, and now we're back, kind of back to reality, so to speak, as we talk about the markets and what's going on from here. So on Friday, there was some economic data out. We had real personal consumption expenditures out on Friday at PCE. PCE inflation came in a bit weaker than what was expected, but spending by consumers was a bit stronger than expected. So overall, it was a good report, more spending, less inflation. But that also inspired the Atlanta Fed GDP to tick up their GDP growth for the first quarter to 2.3%. So that's still down from the peak of where they were expecting it, because we have had some weaker economic data out this quarter. But as we begin into April now, the Atlanta Fed is going to start talking about quarter two GDP, and we'll get the first GDP report for quarter one a little bit later on this month. But right now, Atlanta Fed says 2.3. I would suspect that we're going to be somewhere around 1.8, 1.9. Percent by the actual Bureau of Economic Analysis time to get there. So theirs is always a smidge weaker than the Atlanta Fed, but we'll see. We'll see how it turns out. But about 2%, right around there, growth for the first quarter. Again, not bad growth. We've had fairly strong economic growth all of last year. Of course, we just came off 3.4% in the fourth quarter. So again, GDP growth continues to be strong here. Employment tends to be good, and again, this is why, and yet we really don't have much inflation. So from official Fed inflation is not, still around 3%. So again, this is kind of nirvana for the Fed in terms of hiking interest rates or making interest rate cuts. There's not really anything they need to do. They don't need to hike rates, and they really don't need to cut rates just yet. Now, there's an expectation that we'll get the first rate cut in June or in the July meeting. So we'll see when we get there, because there is some concern, obviously, about liquidity in the system, and that's maybe why the Fed may be talking about cutting rates sooner. But outside of that, the economic data is in a position to where the Fed really isn't a rush to do anything. So again, markets have been rallying on expectations for rate cuts, but again, we haven't really seen the Fed come out and definitively say that they're going to cut rates at the June meeting. But nonetheless, the market has now reversed all of the decline as markets are hitting new highs here of the Fed rate cuts. So even with higher interest rates where they are, doing QT, the markets have already reversed all of that. So in other words, whatever expectation you're going to get in terms of rate cuts has already really been priced into the markets. In fact, if you take a look at where we are, the markets are rising faster than earnings growth expectations, which also is something we'll talk about today as we get ready to kick off the first quarter earnings season. But earnings are growing faster. So over the last 2 quarters, we've had 2 quarters now in a row of 10% advances. And it's not, totally, out there, but it's pretty rare that you have 2 quarters in a row of 10% advances. Now, again, that's bullish. You've got a lot of momentum in the market. That means likely market prices will continue to advance. But this relative strength index, which we've talked about now for a while, has been hung up here right around 70 for a very long stretch. In fact, this is the longest stretch since 2017 that we've had relative strength just kind of stuck close to an overbought condition. Of course, we got to 2018. That's where you had that 20% decline in the markets. But again, this is kind of the point, is that when you look at a lot of the data that's out there, they'll say, oh, when you have 2 quarters of advance, and this is kind of always the case, over the next year, the markets tend to be higher, and that's a true statement. But that doesn't preclude the market from having a correction somewhere in between there. So again, a 10 or a 15% correction, certainly still largely within the realm of possibility to reverse some of these extensions that we've talked about previously. But that's the things we kind of continue to talk about. So here's what you need to know before the bell this morning. Markets continue to really be in a very low volatility advance, continuing to climb right along that 20-day moving average. We look to open up this morning, and right now the implied open for the NASDAQ is up about 82 points. The S&P is going to be up about 9-10 points this morning. 10 to 15 points this morning at the open. So again, you're going to have a fairly strong open. Markets are going to hit all-time highs today, still right within this trend channel. We'll see how the rest of this week plays out, particularly as we start to get ready for earnings season, which will actually kind of start next week. We'll start getting first quarter earnings reports. But overall, again, the market is continuing just to kind of this just floating higher at this point. There's not a lot at this moment to undermine that rally. Again, economic data continues to come in kind of in line with expectations. There's not any real stress in terms of the markets themselves, particularly in the credit related areas. Take a look at credit spreads. Those remain exceptionally bullish here. So again, there's no sign of risk in the market currently. Volatility dropped down last week. We're trading right along around 13 on the VIX. That dropped down below that. We closed the week last week near some of the lower levels that we've seen in volatility. Again, this is just kind of that ongoing decline of this kind of concern about the market. There isn't one. Bullish sentiment continues to remain very high. If you take a look at professional investors, they're now running at 103% allocation. So now they're leveraged in this market. So again, just everything is about as bullish as it can get in the markets right now. There's no concern. There's no risk. There's absolute certainty by most investors this market can only go higher. As we talked about before, we're getting Facebook posts about it's so easy. I just throw money at the market. It just goes up. Doesn't matter what I buy. That's where we are in the markets. Again, nothing wrong with that. But that type of environment typically leads to a correction of some sort. So again, just be cautious here as a function of investing. Don't take on too much risk here. This is easy at this point to get very bullish. In fact, I've got some investing lessons coming out later this week that we'll go over as well, because Mother's Day is fast approaching, be right around the corner here. So I've got some investing lessons from your mother coming out on Friday. But it's just kind of apropos for this market, because again, as we continue to have this advance, this low volatility advance, this is very easy to just kind of start ignoring the portfolio. But that's exactly the time that you don't want to do that, because again, it's when you begin when complacency sets into your own portfolio management, that's when something tends to happen and you get a correction. And again, corrections are going to be fairly minor, 5 to 10%. They're going to feel much worse than that because you've gone such a long period of time without having one. When you do get a correction, it's going to feel terrible. It'll just feel like you're losing money everywhere. But again, that'll be a completely normal corrective move in the markets. That's be healthy, give you an opportunity to put some capital to work. So again, this is where you want to start storing a little bit of extra cash, kind of build up a little bit of a war chest. And that way, when you have an opportunity, you'll have some cash to put to work. The problem for most people that do buy and hold investing, that type of stuff, it works great as long as markets are rallying. But as you continue to dollar cost average in, you're buying at higher prices, but when the markets do correct, you don't have that opportunity to invest a lot of cash at better valuations. And that's the opportunity you'll get. So have a little bit of cash on hand to take advantage of some of those areas that you've been wanting, stocks you've been wanting to buy that have been too overpriced. You're going to get an opportunity to buy those cheaper at some point. So that's what you need to know before the bell this morning. When we come back from the break, we're going to talk about Q1 earnings season, kind of what to expect. We'll go through some charts. Don't go away. More of the Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season candid coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, welcome back to the show this morning. So, a few things. We're going to get into quarter one earnings season, which is right around the corner, about to get started here. Expectations are very high for a lot of earnings beats, and we're obviously going to get that for a couple of reasons. We'll get into that. But, I went back and did some work on the markets going back to 1900 over the weekend. I was just kind of curious how often that you get 5 straight months in a row. So we've had 5 months in a row, November, December, January, February, March. So we've had 5 straight months of gains in the S&P 500. So how often does that happen? And so I went back and kind of just, took the monthly gains and kind of looked at, how often do we have 2 months in a row, 3 months in a row, 4 months in a row, 5 months in a row. 5 months in a row is not entirely uncommon. We've had it about 22 times, 23 times, going back to really kind of 1871, because I was using the Shiller's data to look at this. And so, you've had this, period of time where you've had 5 months or more, not without occasion, right? So, I mean, it's happened quite often. So you have these very bullish stretches in the markets, and that's not uncommon. And but when you look at them, they tend to occur, obviously, first of all, coming out of a correctional phase, like we did in October. So in, July, August, September, October last year, we had that 10% correction. So seeing the markets have 5 months in a row generally occurs coming out of these correctional phases. But they also tend to, kind of align close to at least a short-term peak in the market. So again, lots of bullish exuberance, not uncommon. But you get these fairly long stretches of gains, you're going to get a correction. So again, this isn't really rocket science. It's just that when we get into the midst of these, kind of very bullish markets, that, we're going to have a correction. So, but again, it doesn't mean tomorrow, doesn't mean next month, it doesn't mean 2 months from now. It just means eventually you're going to have a correction. And you just should expect that because markets ebb and flow. That's just what happens over time. But let's talk a little bit about earnings season, because we're about to start into that. Right now we have buybacks still in the blackout window. So we've got to get through earnings season before we get buybacks to come back into the markets. So expectations right now are that we're going to have a fairly high beat rate of earnings. Analysts have been getting a lot more optimistic. In fact, just over the last month or so, they've actually started ratcheting up earnings estimates for quarter one. But again, this is after a very big decline in those quarter one estimates. So if we go back and we look at where we do this every quarter, it's millennial earnings season, but every quarter is the same. You go back to where the original estimates were, look at what they said, we think 2024 estimates are going to be here, and then you fast forward, a few months, and those estimates get to be a lot lower. So obviously, by lowering the bar, we're going to have a whole lot of companies beat that lowered bar. We'll all get excited. This will be great. Companies are doing fantastic. They're beating these earnings, but just remember where they came from to kind of keep things in tow, because right now, the multiple expansion of the market is where the entire return of the market is coming from. So in other words, the market's rising at such a clip here that they're outpacing earnings growth. And I'll show you a chart of this here in a few minutes, but that's all about valuations, right? So a multiple expansion right now is making up 100% of the return of the S&P 500. But clearly what happened, and here's also the kind of the interesting thing. So despite the fact that we're going to have very strong earnings this quarter, earnings are just now getting back. So as of quarter 4, 2023, which we just wrapped up, earnings had not yet eclipsed where we were at the peak of the market in 2022. So earnings bottomed in quarter 4 of 22, and these are reported earnings. So this is GAAP reported, not operating pro forma BS, right? This is actual what they reported, what they actually made, right? So that hasn't even eclipsed an all-time high. So while the markets are all-time highs, earnings have not caught up with where they were previously. Now, the expectation is that we'll, clip above that all-time high this quarter. We'll hit $198 in earnings in quarter 1. So I'll just be a little bit higher than we were in quarter 1 of 2022. And, but clearly a trend. But again, we're continuing to ratchet down. Full year estimates are continuing to come down. And I suspect that over the next quarter, those year-end estimates are going to come down quite a bit more, particularly as we kind of start to hone in on those numbers, because the expectations right now across the board are extremely high. Now, here's the important thing about buybacks. So I said, right now we're in a buyback kind of close, and that window won't open back up until after we kind of get through the first several weeks of earnings reports, and that way companies like Apple, once they report, they can start buying back shares again. So they're in blackout till they report, and then they can buy back shares. But if you take a look at earnings growth relative to buybacks, this is the interesting thing, is that, again, as I said, earnings growth is just now expected to kind of reach back to where we were at the beginning of 2022. So earnings have been mostly flat, really, other than a slight dip. Earnings have been kind of flattish here for a time. Now, they would be worse if it wasn't for the very sharp ramp up in share buybacks, which lower the denominator, right? So EPS, earnings per share. So if we reduce the numbers of the per share part, then earnings are supported by that. So again, this very strong increase in buybacks, which is lowering the outstanding per share basis of earnings, has kept earnings elevated. Otherwise, they would have declined more than they did, right? But that's been the benefit of buybacks. And, so again, this has been one of those supports. Now, as I said, the market, because we're having such a strong increase in the markets now, it's actually outpacing the valuation expansion. So even as companies are growing earnings, the market is rising so fast that it's pricing in all of that earnings growth. So if we take a look at valuations, which is the black line, this is the annual percentage change in valuations versus the annual percentage change in price, we're having this very sharp increase coming off of that low we had in 2022. And we're now kind of back to normally where markets begin to have a bit more problem kind of growing earnings and growing valuation. So again, we're kind of getting that 20% increase. So right around when the annual rate of change of the S&P and valuations reach 20% annualized, that's typically where you run into a little bit of trouble. Now, we've had periods like coming out of 2009 where you had a very deep depression of earnings growth and a very deep depression of valuations. That recovery was very strong. And we got up to about a 50% annual rate of change. We saw the same thing coming out of that shutdown in 2020. When we shut down the economy, coming out of recession, you can have very big changes. Outside of recessionary periods, normally right around that 20% annual rate of change, things begin to slow. Now,
That doesn't mean they don't still, that the overall, this is the annual rate of change. So it doesn't mean that things aren't rising. They just don't rise as fast in the future. So again, continuing to expect 10 and 20% earnings growth and 10 and 20% valuation growth and 10 and 20% S&P growth, those are going to have to start to slow down simply just as a function of time. And it's just unless we were coming out of a recession, we're kind of reaching more extreme levels here. And this is also the problem with the earnings expectations, is that earnings can't grow faster than the economy. And this is the one thing we have to remember. Earnings growth comes from economic growth. So if the economy is growing at 2%, expecting 10, 11, 12% rates of earnings growth is a bit hard to justify. And so if we take a look at the long-term trend of earnings, it grows at about 6% peak to peak, about 5% trough to trough. And so if you look at that peak earnings growth and run a trend line through that, you're going to see that earnings expectations right now are well deviated from that long-term growth trend. Historically, when you've had such big deviations, that's been in line with more exuberant periods of the markets that have preceded fairly big earnings drawdowns. Now, we kind of saw that drawdown. We had a very big deviation of earnings going into COVID. We did have that contraction, but we never had the big contraction because it was offset with $5 trillion in stimulus and $120 billion a month in QE and zero interest rates. And so the market began to recover, but now the expectation is that even without that liquidity, we're going to continue to grow into the future. And that growth is so far above the long-term earning of the ability of the economy to meet that earnings growth that, probably expectations are set up here to be disappointed at some point down the road. It's just a question of when we get there and then what causes ultimately that to occur. But again, this also goes along with corporate profits after tax versus real GDP. Again, when you take a look at where the market's trading versus corporate profits, the deviation between corporate profits and the market are so far deviated from anything that we've seen historically. Normally, deviations of previous magnitudes, the dot-com crash, the financial crisis, which were nowhere near where we are now, led to very big reversions in corporate profitability. Now that deviation is of a magnitude we've never seen before. And again, so, will this ultimately have a reversion to the mean? Yes. And the answer is what causes it. When does it happen? Could be, months from now, could be years from now. We don't know. But what we do know is that the markets have priced in so much future profitability that the market simply can't catch up with it. And so, we'll see what happens. But anyway, we'll come back. We'll finish this conversation up about earnings. We'll also talk a little bit about the wealth gap this morning as well. It's all coming up here on The Real Investment Show. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Danny, you know inflation's getting bad. You remember back in the day when strippers used to have names like Crystal and Diamond after something really expensive?
No.
The Real Investment Show podcast.
Well, now you go to the men's club, it's like, welcome to the stage, gas and eggs. So, I mean, you just know stuff's getting bad, man. Inflation.
Same show, your schedule.
Where'd you get this from, Lance? Is this?
I was thinking about this last night. I was like,
at realinvestmentadvice.com.
Because it's on all cash business.
Yeah.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So it happened again. I went to the ATM on Friday and got a little bit of cash out for the weekend just because we had some running around to do for Easter and, go to church on Sunday, go over to the in-laws' house for lunch. And my kids showed up, and so I have no cash left. Every time. Doesn't matter when it occurs. If I get cash out of the ATM, kids show up. And it's funny because they never have cash, right? They're like, oh, I just have an ATM card. I'm fine. I just have my debit card. It's all good. But for somehow they always need cash for gas. I just, so anyway, they all showed up. It was a good time. Cleaned me out. All went back home. So there you go. So we were talking a little bit about earnings here. And, we're seeing this rapid deterioration in estimates. But, again, the market doesn't really pay attention to that at all. And, that's kind of the interesting part. And if you take a look at the S&P and take a look at the composite analyst, so my buddy over at SocGen, Albert Edwards, produced this chart. And if you take a look, the EPS estimate upgrades as a percentage of all estimate changes are actually declining and have been declining for a couple of quarters. So in other words, the estimates, even the estimates themselves, they're downgrading estimates more than they're upgrading estimates, but yet the market's continuing to rally higher here on expectations of high beat. And and again, yes, because we've cut estimates so much, we will have a high beat rate, right? We'll have 80% of companies that beat estimates this quarter. It was an excellent quarter, and they all beat by a penny. We'll have that type of headline. And, that's going to be very bullish. That's going to keep people invested. But just is what's important about this, the reason I go through this data with you, and I know it's boring, but it's important to understand what you're paying for. and you're paying more for less, right? It's shrinkflation in earnings. It's just like going to the store and buying a dozen eggs, right? You pay more, you get less. Actually, you're still getting a dozen. That's not a good example. You haven't got to where you get 11 eggs yet for a dozen, but you are getting less in a bag of chips. So you go to the store, buy a bag of chips or a bag of Oreos, you're getting less, right? So that's just shrinkflation. You're getting that in earnings, and you're paying more for less. Now, again, that's fine in the short term. In the short term, that doesn't matter because markets are very bullish, sentiment's very high. There's this fear of missing out, so I've just got to get in. So people are throwing money at the market. They're throwing money at everything, right? I was having this conversation with Adam on Friday. You know, we are in a market that is very highly correlated. Everything's going up. Now, everything's not going up the same rate, but everything's kind of going up at the same time. Small caps, mid caps, emerging markets, international, gold, Bitcoin, you name it. Everybody just can't figure out how to get money invested fast enough. So we've got a correlation of 1 on everything. Now, that's okay until it's not. Because the problem with the correlation of 1 on everything when it's going up is you're going to get a correlation of 1 on everything when it's going down. So if you're looking for gold or Bitcoin to hedge your stock exposure, it's not going to happen. They're all going to decline at the same time. And the only question is they decline by more or less. But they're all going to fall at the same time. So the problem for investors is because of all this exuberance right now, everybody's as long as they can get into the markets. The consequence of that action is when you get a reversal, there's going to be no safe place to hide except cash. And so you got to be a little bit cautious here. But, you know, we're seeing the same thing of these downgrades in analyst estimates in NASDAQ as well. So when you start talking about the mega caps, et cetera, seeing a fairly sharp decline in the estimates, or I should say the estimate changes, right? They're less optimistic. And this is those downgrades that we're talking about. So analysts are rapidly out there kind of cutting their estimates to make sure that these companies can beat those estimates going forward. But again, the point is, as I said, is to be very careful about what you're paying for within the overall market. So again, it's just, you know, this is where we are. And, you know, we got here because we injected so much liquidity into the markets. It had to go somewhere. So it went into stock prices. It went into spending of all types. And again, you know, everybody was expecting this massive decline in house prices. Yeah, we had a decline in home prices, but you never had this crash you were talking about because there's just so much liquidity. And as we talked about, I was talking about this last week with Danny, is that houses, you know, kind of around where I live in Houston, they come to market, they're gone the next day. And these aren't cheap houses, and they're going for cash. And so there's just so much liquidity out there that it's got to go somewhere. So it's just going into every asset class. Doesn't matter what it is. Doesn't matter whether there are fundamentals to it or not. We're just throwing money at it because it's all going up at the same time. And if we take a look at monetary supply, M2 as a percentage of GDP, this is the one thing we continue to watch fairly closely. GDP is slowing. Monetary supply is slowing. And so as monetary supply slows, we're going to see this more reversal in economic activity. And you're going to see less earnings growth in the future. So again, we keep seeing these downgrades in earnings, and you should, because you're going to have less economic growth in the future. That's just a function of the lack of monetary supply. If we take a look at liquidity as a function of M2, and we can take that same graph of monetary supply, subtract out GDP, so M2 minus GDP, just kind of looking at pure liquidity. And, you know, we're still seeing a lot of liquidity. Now, we've had a big change in that liquidity, but we're still seeing an uptick in liquidity, which has been kind of tracking along with this S&P, but the S&P is running much higher than that liquidity bump from the spending we've got. So the markets are well ahead of where the liquidity is in the markets. And in fact, if you look at an annualized rate of change on the S&P, it's now starting to reach levels that on an annualized rate of change is not really sustainable. You can't keep growing at this pace. So there's going to have to be a reset to what's the actual liquidity in the markets. And historically, there's a very close correlation between M2 minus GDP and the annual rate of change in the S&P itself. And that's going to have to reconnect at some point. Either liquidity is going to have to catch up fairly quickly and the market goes nowhere, or you're going to get a reversal in the markets at some point. So that's just a function of that. And so, but what's all, again, as I said earlier, what's important is to understand what you're paying for your investments. And now, look, I'm not saying not to be invested. I'm not saying that at all. I'm just saying just be aware of what you're paying. It's okay to overpay for stuff in the short term as long as you get out, right? This is the greater fool theory. As long as there's somebody there on the other side willing to buy it from you at a higher price, you're fine. The trick is not to be the last guy standing when the music stops. And again, that's going to happen. It's just a function of time till we get there. But valuations, and if we look at both pro forma versus operating, there's a fairly big gap between the operating and pro forma valuation levels. But again, they're both rising sharply. Again, this is that multiple expansion. So this means that prices are rising faster than earnings. And so we're getting a fairly sharp increase of valuations in terms of a valuation expansion issue. And if you look back historically, fairly sharp increases. Now, again, we're early here, so we could still move further. And again, I'm not predicting anything to for tomorrow, but we could still move further from here. But we're now getting to that very sharp increase in valuations where markets are pricing in all of the earnings growth expectations and more. And that typically happens just before you get a valuation correction at some point. As you can see, when historically these kind of sharp upticks do reverse. And that suggests that we need to at least be aware that valuations are expanding, fairly sharply. And we also see the same thing when there's a big gap between operating earnings and pro forma earnings. Operating earnings, which are pro forma, and reported earnings. We have a really big gap. And so, again, at some point, that gap is going to close. Again, don't know when. Could get bigger before it gets smaller. But at some point, you're going to close that gap. And that's just a function of how all this works. So, this is the key takeaways here as we kind of began to get into the earnings reporting season starting next quarter. Starting next week, is that as we start looking at those, we've got to evaluate and be aware of what we're actually paying for. And again, we're just getting very, very excited and exuberant in the markets. We're all very optimistic right now. And you take a look at sentiment, take a look at our fear greed gauge that we run in our weekly newsletter. That's the extreme greed level. And that's based on allocations, right? So just investors are just about as long as they can get on equities. They just, they have bought everything they can buy. They're starting to leverage up. We're seeing margin debt starting to increase. So people are taking on more debt in order to invest in markets. Again, all signs of bullishness. Expanding margins is more buying power that helps promote the bull market. Just understand that that's the late stage sign of an advance. And that eventually you're going to get to some point, something will happen that you get a reversal. And as I said earlier, you just don't, like Chuck Prince said at Citi, he said, when the music's playing, you got to be dancing. But again, like a game of musical chairs, when the music stops, you don't want to be the guy left without a chair. So just paying attention to that. Okay, we'll come back, get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got a burning financial question you've always wanted to ask Richard Rosso and Danny Ratliff?
Stocks or bonds?
Annuities or not?
Who does your hair?
Our next Candid Coffee goes back to our roots and back to the kitchen table with an open season session for any and all of your questions. Saturday, April 20th.
What about tax loss harvesting?
Should I take Social Security now?
Where'd you get that snappy robe?
Register today for our open season Candid Coffee at realinvestmentadvice.com for just about anything you want to know.
Where'd you get those shoes?
realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So a while back, I wrote an article and I quoted the Manhattan Institute, which said that by eliminating jobs and or reducing employment growth, economists have long understood that adoption of a higher minimum wage can harm the very poor who are intended to be helped. And, you know, of course, we were talking about that time, there was a big push by activists to have a national increase in the minimum wage to $15 an hour. And we simply were writing about the fact that economists understand that if you do that, there's no free lunch, right? Something crosses and breaks at some point. And that if I'm going to increase the wages on the minimum side, I also have I have a wage increase across the entire scope of my business because, as we said back then, maybe have some minimum wage workers, maybe I have a fast food restaurant as an example. And so so I have some minimum wage workers, they're earning minimum wage, so I take them to $15 an hour. Well, my manager was making 15, so now I've got to take him to 25, and my regional manager was at 25, so now he's 35. So if I raise the bottom, it runs right up the chain of my employment, which is labor is the biggest cost for any business. So, you know, if you take a look at a franchise, say like a Subway, they're profitable businesses, but they're not massively profitable. Unless, I mean, if you own multiples of Subways, an example, then, you know, you start making some money. But a standalone store does not make a tremendous amount. I mean, it's not just printing money left and right, where you can just absorb any cost increase. They're not that profitable because you've got to pay labor, you've got food costs, you've got all these other things that go in there. So yes, they make money, and the guy that owns the franchise makes money, but he's paying franchise fees and everything else to Subway. So again, there's not a huge amount of profitability coming out of these businesses. And so if I increase the minimum wage in these restaurant type businesses in particular, there's going to be a consequence for that. A CBO did a report on this, the Congressional Budget Office, and they said that reductions in employment let's raise the minimum wage. What the CBO said is reductions in employment would initially be concentrated at businesses where higher prices quickly reduce sales, i.e. restaurants, which is already having that problem because of inflation. We're starting to see less traffic at fast food restaurants, et cetera. And then, of course, this whole tipping dynamic that's been going on is kind of turning people off of going out to eat. Back to CBO, over a longer period, firms will replace low wage workers with higher wage workers, machines, and other substitutes. So in other words, if I can bring in a machine or another substitute, or I can pay somebody more to do the job of 2 or 3 lower wage workers, then I'll do that, right? Because that saves me money. CBO goes on, a higher minimum wage shifts income from higher wage consumers and business owners to low wage workers. Because low wage workers tend to spend a larger fraction of their earnings, you might see an increased demand for their goods and services, which would boost employment short term. But at the same time, a higher wage, and this is all from the CBO, decreases the number of low wage workers. So yeah, I may pay low wage workers more. I may see a benefit from paying low wage workers more. See, this is the thesis of the government. Oh, if we just pay low wage workers more, that's going to increase GDP. Well, the problem is yes, they will spend more if they keep their jobs. The problem, according to the CBO, is that it decreases the number of low wage workers, reduces the and increases the productivity of machines that can replace them. The reduction in capital resources of lower wage workers' productivity, which leads to further reductions in employment. That's from the CBO. Now, why am I bringing this up? Because today, April the 1st, is Governor Gavin Newsom's $20 an hour minimum wage starts. So this is going to be, so we've written about these, about minimum wages in the past and the consequences of increasing the minimum wage. We're going to see it real time now. We'll get to see if all the theory that was put out there previously about kind of what anecdotally we know comes to life, because there are a tremendous number of minimum wage workers in California. Today, they have to be paid $20 an hour. So this is up from 15. So that's a 25% increase in salaries or wages in one day. So on Friday, I paid everybody $15 an hour. Today, I'm paying $20. So all of a sudden, my payroll cost just went up 25%. So businesses are going to have to make a decision. Do they absorb it? Do they raise the cost of the menu items? Do they just shut down, move to another state? Do they automate? These are all we're going to see what happens. So we're going to see just how good this idea is. And maybe all the theory's wrong, right? I've owned my own business for 40 years now. Right? So I've had employees, I've hired people, I've fired people. It's, all this. And labor is the biggest cost. I mean, and it's always interesting because as a business owner, I'm looking at my bottom line going, okay, this is what I get to take home. Why are my employees making more money than me? Right? That's the cost of labor. Labor, healthcare costs, all this other stuff. Right? It all leads into the profitability of the business. And so now you're mandating an increase in an area of a business that corporations have a kind of a minute control over. My control is hire less, replace workers, raise cost. Problem is I can't really raise costs too much. I can try to take the 25% increase in my minimum wage workers, and I can try to pass it on to my consumers. But how many consumers are going to be willing to pay a 25% increase in the cost of a burger? So there's a limit. We don't know where that limit is yet, right? We're going to find out here fairly shortly, and we'll find out by watching California. But we're going to find out what the limit is. There's a limit to where consumers revolt and say, I'm just not going to pay $35 for a Big Mac or whatever. I'm making numbers up, but I'm just saying. I mean, the cost of Happy Meals are not cheap anymore. So where is it that these consumers start to revolt? And where is it that businesses start to revolt? And franchise businesses have options, flexibility that, so if I'm an individual and I own my own restaurant, so I'm in California, I've got a little burger stand. And all of a sudden, I now have all of this increase in minimum wage workers. So I've got some choices. Either me as the owner, I'm going to be in there slinging burgers all day and getting rid of some of my part-time work, or some of my minimum wage workers. I'm going to have to just take on more liability as the owner. I don't have a lot of flexibility if I want to stay in business. So a lot of small business owners will just close up shop. They'll say, I can't afford to be in business because of this, and they'll just close up shop. Franchises have a little bit more flexibility because of their scale. But again, if I'm McDonald's, am I going to shift the burden of my California franchisees onto my Texas franchisees, as an example, and absorb some of those costs? Say, look, I know you've got to pay $20 an hour, even though every other franchisee in the country doesn't have to pay $20 an hour. I know you do. So we'll absorb some of those higher costs and I'll pass it on to all of my other franchisees. Maybe. Or is it, hey, you're on your own. It's your franchise. Float or swim. You know, that's your choice. We'll see. And again, I think this is just going to be very interesting. We'll get to see what happens, and we're going to hear a lot about this today. Obviously, it's all the headlines that fast food minimum wage in California goes up to $20 an hour. We'll see what the impact is. But I think this is going to be a very interesting case study to watch about A, where the limits of minimum wages are, and B, what happens in California in terms of employment, in terms of small businesses. You know, is this the point that is this the straw that kind of breaks the camel's back? We'll see. But I think this is going to be very interesting to watch. You know, the important thing to understand, though, is that there's only about 3 to 4 million people nationally that work minimum wage. Most people don't work minimum wage. Minimum wages were never meant to be a full-time job. So we're trying to make minimum wage jobs being a living wage, and that's not what they're meant to be. These are starter positions to get people going, and this is kind of your sink or swim moment. You do well, you get to move up, you make more money. If you don't do well, you get fired. And now we're making this burden of minimum wage apply to all companies, which could very well have a fairly negative impact across the board. We'll see. As I said, I think this will be a very fascinating thing to watch. We'll keep you updated on the outcomes of this here over the next months as it occurs. I'm sure I'll be writing some articles on it as well. Tomorrow we've got an article talking about the markets. On Friday we've got investing rules from your mother. So we got some good reports coming out this week for you all at the website, realinvestmentadvice.com. Be sure and like and subscribe to the channel. We appreciate it very much, and we want to continue growing this and getting out there to more and more people, and your help is very much appreciated. So like and subscribe to the channel. We appreciate it very much. Get by the website, realinvestmentadvice.com, and we'll see you back here tomorrow.